Welcome to the Beckonomics Podcast. I'm your host, Victor Beck, here alongside Hunter Beck, as we break down weekly market movements, macroeconomics, and what investors should be keying into as we look forward in this market environment. As a note, the topics discussed and opinions given are not intended to address the specific needs of any listener. This material represents an assessment of the market and economic environment at a specific point in time and is not intended to be a forecast of future events or a guarantee of future results. Forward-looking statements are subject to certain risks and uncertainties. Actual results, performance, or achievements may differ materially from those expressed or implied. Information is based on data gathered from what we believe are reliable sources. It is not guaranteed as to accuracy, does not purport to complete, and is not intended to be used as a primary basis for investment decisions. It should also not be construed as a solicitation or advice to buy or sell any security mentioned. Past performance does not guarantee future results.
Hey, Victor, how's it going?
Good, Hunter. Looking forward to today's podcast.
Yeah, so we just got a latest Fed meeting a couple of days ago, and new dot plot and some macro updates. You want to give us some more details?
Absolutely. Looking forward to kind of running through what the Fed is looking at, what we're looking at in regards to that, and just overall interest rate policy and what we're keying in on when it comes to this very still Fed-driven market. So first, I want to remind our listeners why does it matter? Why is the news, CNBC, Bloomberg, the WSJ? I mean, everybody's talking about the Fed and what they're doing with interest rates, and so I want to bring us back to why do interest rates and interest rate policy matter so much? And it's that when you have higher borrowing rates, so higher interest rates, which very much controlled by the Fed, that means less borrowing across the economy. And so to take this from a high level, the Fed has a dual mandate, and they're focused on keeping inflation low, price stability, and maintaining maximum employment, so keeping unemployment low. And so whenever we got way ahead of ourselves with inflation over 2022, the Fed had to take action and rose rates to what the current level of 5.25% to 5.5% interest rates. What those higher rates translate into is that less borrowing, as I mentioned, which really cools economic activity. So the less borrowing going on in the market, the fewer dollars that are flowing around. And the idea behind that is with fewer dollars fueling the economy, you're going to have lower inflation because the standard definition of inflation is too many dollars chasing too few goods. Now, of course, through the COVID period, we saw a combination of there being a lot of dollars in the market and too few goods from lack of supply chains, which kind of leads us through what we've talked about in the podcast before and some of the things that we've written about, how now you're seeing inflation cool considerably because you've got this dual combo of fewer dollars, a lot of that driven by those higher interest rates, and more goods driven by better supply chains in the market. So Hunter, do you want to kind of give us just an overview of where we're at with interest rates and what we're kind of looking at as far as, the high level numbers go?
Yeah, Victor. So the Fed is currently sitting with a policy rate of 5.25% to 5.5%. And so policy rates are one thing, but how that really translates into the market and what we see, what affects the economy, give us a little better idea of that is the 30-year fixed mortgage is at 6.9% almost right now. And while that is historically being the last, decade or two, pretty high, that is well off the peak of over 8% in October. So now that that's been coming down, those mortgages still not super appealing to people who locked in sub 3%, jealous of those guys, but it's rapidly coming back into a workable interest rate range for a lot of people. And, just kind of proof of that, existing home sales were higher in February, more homes on the market in February than traditionally. We'll get more into those details a little bit later on. But really just that story of these mortgage rates coming down, bringing more sellers, more activity back into the marketplace. And as I mentioned, kind of highest supply of homes on the market in February in the last 4 Februaries that we've seen. So not highest total, but February is really really a little on the early side of that selling season, and it's really good indication so far this year. And so median sale prices have continued to rise, which is very important in regards to inflation. That's all it's about is sale prices. But along with that, I think as we get more activity in the market, more turnover of existing homes where new homes kind of make up a smaller percentage of home sales, we'll see that median price come down a little bit.
Yeah, we've mentioned on the podcast before and talked about those golden handcuffs. Those low mortgage rates have really held those homeowners in those mortgages for longer than one might expect. And so, yeah, I think it's a great thing to see those mortgage rates come down to a more modest range. And as you mentioned, we're seeing more, existing home activity because of it.
Exactly. So, Victor, you want to take us into a little bit more detail on what we saw from the Fed?
For sure. So every other Fed meeting, we get what's the Fed calls the summary of economic projections, referred to as the dot plot because it projects where Fed governors and presidents are looking for Fed policy to go in the future. And we saw essentially the same thing that we saw back in December. We're looking at 3 interest rate cuts of 25 basis points or 0.25% over this year, and then 3 cuts in 2025. So the Fed actually decreased the number of cuts they expect for next year, down from 4 in the last dot plot. But we were essentially looking at the same kind of interest rate policy mentality from the Fed that we saw 2 meetings ago, which was the market responded to very positively. I think people were afraid that the Fed was going to project 2 interest rate cuts this year or, even fewer in 2025. And so what we saw from the Fed this last week was very positive from, hey, this is, kind of a stable outlook as far as what we're looking at with interest rate policy, because what we've seen over the last 2 years is, huge fluctuations in the Fed's thinking about how interest rates are going to operate, where they're going to find a terminal rate, and, what their policy is going to look like. So some relative stability looks really positive. And, they keep working towards what their kind of long-term expectation for the Fed funds rate is, around 2.5%. So as you mentioned earlier, we're at 5.25 to 5.5. That means there's a long runway towards that 2.5%, but they expect to make progress of, call it 75 basis points over the course of this year. They also revised GDP up and unemployment down in their projections, which of course, higher GDP, lower unemployment, good things for the market. If you can do those 2 things while also expecting interest rate cuts, it means that 1, we have a strong economy, and 2, we're going to have falling rates, which is really good across all asset classes, should provide, good support, stabilization for, equities, fixed income, and just good acknowledgement from the Fed that the economy remains strong.
Yeah. And so just to give a little bit more context, back in December, the market was really kind of getting ahead of itself in pricing these Fed cuts. They were projecting 4 to 5 cuts, I think edging on the five cut side of that for most of the end of the year. And now that's come back in line with the Fed, so as we mentioned in a previous episode where we talked about that a little more in depth, the market uses these futures to kind of speculate, but also hedge themselves. And we've seen a lot of that fall off. So it's understandable that they got a little ahead of themselves, but now all that's rolled back off and people back in line with what we're expecting from the Fed.
Yeah, I think it's really healthy to see the market and the Fed aligned here. For quite a while, there was quite a disparity between the two. And so now that those two are aligned, you're looking at what should be a more stable market as a result. And I think everybody can recognize that as a positive. Now, when it came to the press conference, Jerome Powell, I thought, did a very good job of saying a lot and saying nothing at all at the same time. That's kind of the typical, Jerome Powell mentality. Let's, say a lot of words, but not give the market too much or, create some kind of hypothetical scenario based off of what the press is asking him. I appreciate that from him. I think, we've seen Fed governors or Fed presidents in the past talk about, hey, hypothetical this, hypothetical that. Whereas, what the Fed can only really rely on is the actual data. And that's going to get to what we're going to talk about a little bit about their data dependence. And I'm going to mention the terms dovish and hawkish. And just for our listeners, whenever we talk about the Fed being dovish, that just means easier monetary policy, being, lower rates, less quantitative tightening. And then hawkish being the opposite, where they're talking, expecting higher rates, tighter monetary policy. So just, some terminology for our listeners. But Jerome Powell definitely tilted a little bit towards that dovish, more easy money kind of mentality at this meeting, although he did maintain that kind of data dependent stance and didn't give an expectation necessarily for when interest rate cuts are going to happen in the future, but did give a little bit of a nod to some adjustments to quantitative tightening. So we're going to talk about this a little bit more, later in the podcast, but quantitative tightening is essentially, how much of the Fed's balance sheet are they going to let roll off as far as, bond purchases go. The Fed balance sheet grew to near $9 trillion over the COVID period because of how much monetary stimulus they're putting in the market, just buying treasuries, pumping more dollars into the marketplace. And now that's come all the way down from 9 trillion to 7.5 trillion. So they're actively letting 60 billion a month of treasuries roll off their balance sheet. So the fact that the market's been able to soak that up so far has definitely been a positive. But Jerome Powell throughout the press conference reiterated a number of times that they are, quote, very soon, very close to changing their quantitative tightening policy. And most of us on the street kind of expect that they'll cut that roll off from 60 billion a month to closer to 30 billion a month, which just means that there's not so many dollars being sucked out of the market, which is definitely a positive, across asset classes.
So a quick note just for our listeners, when we're talking about their balance sheet rolling off, the Fed is still actively buying securities. They're just buying fewer securities than the number of dollars that are maturing. So as these treasuries mature, money gets paid back to the Fed. They buy more treasuries with that money. However, not as many as, came mature. And so they're netting dollars in. And the market is seeing relatively less buying because of it.
Yeah, that's a great point. They're not actively selling bonds into the market, just letting more of that debt mature and not, repurchasing as much as what's currently on their balance sheet. They also, I thought it was important that Jerome Powell recognized that GDP growth is strong and unemployment is low. But the key part of that, and this was a question that was asked during the presser, was that he doesn't feel that the job market needs pain to get inflation back to 2%. If we were to go back to some of the Fed meetings and press conferences in early 2023, Jerome Powell did note that there needed to be pain in the market for inflation to get back to where they want to see it. And now he's reversed course on that. So he's saying, hey, the job market can be strong. We're seeing inflation decline. We're not going to have to cause damage to the consumer and the American economy to get inflation back to 2%. And that's obviously a huge benefit both to, consumers in the job market and equity and fixed income markets, because, without pain to the economy, that means that we can have a much more stable glide path down to that 2% level and a better landing for the economy. Now, Hunter, now that we've kind of covered what the Fed has seen, what they're talking about, where we're at, what's going to trigger this first interest rate cut? When do we expect that to happen? And, how are we thinking about that as market participants?
Yeah, so a lot of nuance, lots to unpack there, but, the Fed's very much staying data dependent. So while the market is currently expecting that first cut to come in June, that could be sooner or more likely later. June is the expectation. However, if inflation doesn't come down as much, if there are cracks in the job market, slowing in GDP, they're going to adjust course to compensate for that. To try and glide us into that soft landing without creating too much pain for the economy, but also being confident that inflation's on a good path downwards. And, during the press conference, Jerome Powell acknowledged that January and February CPI data was a little bit higher than they'd like to see, but it really came back to something they'd been talking about for a long time, is that it's going to be a bumpy path down to 2% inflation. And this is just a bump in the road. They're not ignoring the data, but for the time being, until anything tells them otherwise, they're going to treat it as just a bump in that path. So still very much like on target for a June cut, but that can vary depending on how the data comes in. And the last point I really want to make on that is that the Fed is being very careful here. They want the data to be fairly conclusive, but there's also a big pressure out there not to be late to the game again. So they were really late in hiking rates the first time to kick this whole thing off. And so I think there's a lot of pressure in the market and just the politics that the Fed tries to stay out of to not be late again. And so they're trying to balance a lot of things, but Jerome Powell doesn't want to put the economy through a bunch of pain if that's not necessary.
Yeah, I think the fact that inflation has declined more steadily over the last couple of months is a little bit almost a benefit. I mean, we want to see inflation get closer to that Fed target of 2% so that they can feel justified in cutting those interest rates. But I think you and I were talking, and what we were fearing, and a lot of analysts across the street were fearing, is that you'd have inflation decline too quickly. And all of a sudden, if you have no inflation, then that causes a lot of problems for the market. We felt, hey, we don't want the Fed to be late here. And I still think that the Fed could probably go ahead and cut at any meeting coming up, and they would be okay because, like you just said, I mean, we want them ahead of the curve, not behind it. So it would be good to see them kind of acknowledge that and get in front of this thing, but they're maintaining a very conservative stance. Inflation's still declining a little bit slower, and I think we are hitting a nice glide path towards that 2%. And we just have to hope that the Fed is able to cut rates early enough and quickly enough so that we can kind of maintain that smooth sailing down towards that 2% target.
So that's great from a macro standpoint. Lots going on with the Fed, as has been for months now. But let's talk a little bit more granular about this, and kind of how does this really translate into what we're doing here at Beck Capital Management?
Yeah, thanks for asking that. I think what we're really looking for when interest rate cuts begin to happen is a few areas of the market. I think we've mentioned this on the podcast before, but I want to reiterate that the small and mid-cap companies, they really hold and have a higher impact from the debt on their balance sheet. So lower borrowing costs should really benefit those companies. I know that we kind of prefer right now the equal weighted S&P 500 just because those small and mid-cap companies have kind of been left behind by the recent market rally. And so there's an opportunity for greater market breadth in kind of the next leg of this market advancement. And as those interest rate cuts come through, we think that areas within those small and mid caps, definitely sector dependent and industry dependent, but I think that's an area that we're really attuned to watching. Another piece of that is the amount of money in money markets. This gets talked about a decent amount, but there's $6 trillion in money market funds right now. And that's really because you can earn, about 5% on that money market fund. Well, people are happy to hold that in cash for the time being, but that's liquid money that once you're not getting that, 5 to 5.25% return on your cash, you're going to want to put that somewhere, whether it's fixed income, equities, alternative investments, heck, maybe even crypto. That money is going to flow somewhere where investors feel like they can get a return. Money market levels were next to zero when we were under zero interest rate policy because you couldn't get any money on your cash. Cash was quote unquote trash. So we expect that to be a slow transition out of those money markets. It's not going to flow overnight, but it's already started to kind of move out of those money market funds towards assets that investors feel like can earn them a better return.
So the last bucket that we're really going to look at or really talk about today are those consumer items that are fairly reliant on cheap financing that we used to be able to get and no longer have. Those items that have really pulled back. A lot of these are, anything that you're going to be financing. So it's going to be bigger ticket purchases. But we're talking about homes, your kind of green energy projects that have a good payoff under cheap financing, but don't really make so much fiscal sense right now, such as solar panels. I know can be a good payoff structure. The financing is cheap enough, but when you're paying a lot for solar panels and a lot in interest to fund them, it's just not always worth it right now. And then along those lines are autos, and that's everything from internal combustion to electric cars and kind of the latest trend in the market towards hybrid electric vehicles that can start making that EV push without all of the burdens that come along with being totally reliant on that EV power grid that's still being built out.
Yeah, definitely. I also want to mention real estate just in general, kind of more on the commercial side. Of course, you talked about the retail side being housing, but we're looking at real estate just as an entire sector that's really been hurt pretty significantly by these higher interest rates. So finding the right pockets of quality real estate on the commercial side that's going to benefit from those lower borrowing costs. A lot of that debt is renewing right now. So looking at companies that, hey, maybe their debt doesn't mature this year because those companies are still going to get hit by those higher interest rates, but whose debt's maturing in 25, 26, that's going to face, a little bit easier interest rate levels, but has quality assets that have gotten hit hard during this higher interest rate policy that could show growth and appreciation in the future. Well, I think we gave a pretty good overview of what's going on with the Fed, why it matters, what we're looking at specifically. Hunter, you want to take us home?
Yeah, well, thank you for joining me, Victor, and thank you, everybody, for listening to another episode of the Beckonomics Podcast.